if you took your money and instantly bought something like a TV, you're getting instant consumption. But if you instead delayed that TV purchase, invested it, you're taking on a risk, and the return you receive is the reward for delaying consumption, essentially. When
hopefully,
I mean, hopefully, yeah. That's right. I mean,
1, 2, 3, 4.
All opinions expressed by Ryan and Chris are solely their own opinions and do not reflect the opinions of 5i Research or i2i Capital Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Okay, hello everyone, and welcome to our latest podcast episode with Ryan and myself. Here we have a pretty packed agenda for today. We're going to be talking about a few things. First is kind of general overview of different market insights and different company news. Then we're going to be looking at noteworthy dividend cuts and raises across Canada. I'll be highlighting and spotlighting a recent Canadian MoneySaver issue. We're going to be diving into 4 noteworthy Q&A questions from 5i Research, so 2 from each Ryan and myself. I'll be highlighting a recent 5i report that we've done for a Canadian company, looking at some investor education on a broad investing in market topic. And then lastly, just some interesting news that we want to discuss about the general markets. So with that said, Ryan, I'll let you kick it off with kind of your general overview of the market dynamics today.
Perfect. Yeah. Hopefully this will be the first of many of these podcasts we're having, and just kind of a sort of a fun, interesting conversations about just what's going on in the markets and things like that, and different developments. So start off with just a bit of a market overview. I think if you went back 6 months and told people about what markets were, all the different developments we were going to have year to date kind of thing, I think everybody would think markets would be in a 20% drawdown or something like that.
Right.
It's actually, we're flirting with all-time highs pretty much across the board in markets. And Europe's really the standout, and that's a market that's been call it dead money for probably at least a decade or so, and now it's finally having its time in the sun, which is a bit of a testament, I think, to diversification, right? No one probably enjoyed holding Europe for such a long time, but it finally worked, and hopefully it won't take another 10 years for Europe to kind of keep providing returns for investors. But those types of things, and gold as well, right? Those are just good examples of I think why diversification really is important. When you least think you need it, it comes in handy. So overall markets remain pretty resilient, which I think has been the story across the board for the last 10 years, regardless of whatever kind of bad news is to come our way. Markets kind of keep plodding along. The most recent earnings season actually looked pretty good too. I think with all the tariff drama and volatility, a lot of people were expecting, a slowdown or earnings surprises or whatever. But largely the earnings were in line, I'd say. Obviously there's always companies that are going to have bad earnings and good earnings and all that kind of stuff. But the broad sentiment seemed to be in line types of earnings, maintained outlooks, so maybe even some guidance increases, like more than expected kind of thing. I think the big, maybe wasn't a surprise, but I think you had a lot of companies that were pulling their guidance. They just said that's with all the tariffs too much. Like, we don't know what's going to happen, so we're just going to pull the guidance until we get more certainty, which makes sense. So
right.
So I don't even think that was a surprise. But we had a lot of that too.
We had a lot of tech surprises though to the upside. I think there was a lot of tech companies that didn't pull guidance, but also instead raised it, and I think that kind of lifted the whole AI sphere. Lots of tech names. It was kind of encouraging to see, for sure.
Yeah. Well, in a lot of cases, you'd think they'd be least impacted by tariffs too, because if it's software, it's not really in the realm of tariffs per se. So, but ironically, they all got hit pretty hard too.
Going into it.
And I get why. It's because if you economic slowdown or recession or whatever, then yes, everything's gonna kind of get hurt.
Yeah.
But
the highest beta stock to be sold off.
Yeah. But a lot of those names haven't bounced back quite the same as some other names as well, which is kind of interesting. So on top of that, geopolitical tensions, it seems every 3 or 6 months we have sadly some new event happening in the world. I think that's just going to be par for the course for the next little while. But the markets just kind of, for better or worse, seem to be shrugging it off and keep kind of trudging forward.
Yeah, no, definitely. It's grinding to new highs. We're, less than 1% away from all-time highs across the U.S. broader markets. And, but it's interesting to note that there's still like investor skepticism mixed with some investor cautiousness, even though we're just about at all-time highs. So
wall of worry.
Yeah, that's certainly climbing the wall of worry.
On noteworthy company news, I won't go into too many specific companies today. Probably next time we'll get a bit deeper into it. But through earnings season, so largely it's been pretty quiet over the last couple of weeks, right? If there's been big news, most companies kind of get that out the door before or during their earnings releases. So I think I think you're going to talk about this a bit down the road here. But kind of, I'd say one of the bigger developments lately is that IPOs seem to be hot again. So you've had CoreWeave, an older IPO, but certainly recent in the scheme of things. And Circle is also recently IPO'd, which is in the stablecoin space, and both of those have been quite successful IPOs. So looks like maybe there's a bit of an IPO window that's opened up, and we're going to be having more companies come to market, which is probably just a good sign. And if you want to talk about animal spirits or something like that, so so that's probably the big newest development, I'd say, that are happening in markets, and shows a bit of a risk appetite coming back, which is a good thing.
Yeah, definitely. Yep. And next, did you want to go over some of these dividend highlights? I can bring this up to the screen.
Yeah.
So what do we got? Go.
Over at 5i Research, we track have a page that tracks dividend changes over I think we're doing it for at least a couple of years now.
Several.
Pretty long list over there. But all in Canada, all the big banks have done their earnings, and they all kind of typically raise their dividends in the same range. And so they've all done about roughly a 4%. All the big banks have done a 4% dividend increase, roughly, which is kind of seems par for the course for them, which is nice for those people who like those dividend growers. We have Dominion Lending Centers had a notable raise with a 33% dividend increase. Magellan Aerospace, this one's probably one of the ones that really jumps out to me. They increased their dividend by 100%. And the aerospace sector in general has been pretty hot right now. I know MAL's been pretty good in the last little while.
Across both Canada and the US, which is kind of like definitely notable. That usually doesn't happen.
No, well, and Europe too, right?
That's right.
I don't know why that's happening, but those ones have had quite a run as well. So that's dividends are always a nice sign that if you raise a dividend, you typically don't expect that you're going to cut it down the road, because markets never like a dividend getting cut, obviously. So when they raise it, they're typically, or at least you would hope, management teams are very confident that they're not going to have to decrease that dividend anytime soon. So 100% dividend increase is a pretty nice sign. If you're a Capital, on the other side, they've cut their dividend by 50%. And this is a good lesson on the risk of really high yielding stocks. So I think Fiera has typically has had a high yield for years and years, and oftentimes when your yield is that high, it's a sign the market's trying to tell you something, that there's a reason the yield's so high. It needs to be that high to entice investors into the stock, into investing in the company kind of thing. So and oftentimes we find those really high yielders those dividends get cut eventually. Just like BCE, which is the next. So they finally cut their dividend by 56% on, I think it was May 8th, it looks like, when they did that cut. So this was the most long-awaited, expected, but put off dividend cut, I think, almost in the history of dividend cuts over the last couple of years. So it took a long time to do it, and they finally cut it, which was the right move, but it was probably the right move a year late almost.
Right.
Time frames are right there, I think.
Yeah, that's fair.
And then Propel Holdings, they raised their dividend by 9%, and Dental Corp raised their initial dividend. Yeah, so a first dividend, which is also kind of similar to the idea of when you have a dividend raise, do it because you don't want to cut it. You're not planning on cutting it. First dividends are a really nice sign, because it's kind of almost a transition moment for a company saying,
Hmm.
you know, we built that base of revenues, the base of earnings, whatever, and now we're here, we're ready to pay a consistent dividend. You can trust us, and you know, maybe we'll. A lot of times, companies after the first dividend will tend to increase it over time as well. Not saying that's the case with Dental Corp, but regardless, kind of that first dividend is a nice sign. Companies management are kind of trying to jump up and down and say, "Hey, look at us, we're paying a dividend now." So that's a good one.
Nice. Yeah, I like it. It's a solid list, and it's a really nice page that we have too, where we kind of like outline these on a monthly basis. And anyone that, you know, doesn't want to track their individual holdings and what their dividend increases or cuts look like on a monthly basis, this is kind of a pretty good resource to go to just check on like Canadian dividend raises and cuts. So yeah. Okay, so next I'll be talking about a recent Canadian MoneySaver issue that we wrote. Okay, so the title of this MoneySaver article is "Don't Get Duped: Spotting and Avoiding Money Scams in 2025." So this is kind of like a popular topic right now. I mean, scams have been happening for a long time, and especially like we're seeing the proliferation of scams, especially with today's digital environment. So, you know, this one kind of mentions talks about grandparent scams. So essentially, you know, scammers will target individuals that are likely grandparents. They'll impersonate their grandchildren in distress. They might even say like, "Hey, this is your favorite grandson." And then the grandparent will kind of say like, "Oh, is it so-and-so?" And they'll say, "Yeah, it is. I'm in jail and I need money." And of course, the grandparent, if you know, if they're caught off guard, they might send over money just because they're worried about their grandchildren. So this is an article that kind of talks about like how to avoid these scams, how to watch out for scams. But, you know, I wanted to talk about too, like how it's even more challenging and difficult today with AI, because like AI, you can use voice mimicking technology or fake caller ID. So you can, you know, mimic the voice of someone's grandchild so that it's almost impossible to really determine like, is this actually someone that I know or is this AI? And so I think a lot of people kind of listen to this will say like, "Oh, I wouldn't fall for that. I would never do that." But like, you know, the reason that these scams happen and that people get away with money is because at times people will be vulnerable, and it's in those vulnerable moments that people can fall victim to scams. And especially when there's a sense of urgency, people can kind of, you know, let things slide just by, you know, poor timing or whatever it might be, and they just kind of lose their sense of judgment. So yeah, really, you know, the key summary of this article is to never give out personal information impulsively. And, you know, if you can, verify the story with another member of your family. So if someone gets a call, you know, it sounds like a scam type of call, and it's, you know, there's a sense of urgency and they're asking for money, it's best to just hang up, verify that story with a family member, and make sure that the story is accurate. And this one, I think, is this next part, I think, is most important in today's AI world. It's, you know, setting up a code word for your family that you can ask in case of emergency. So, you know, with AI, if someone's impersonating your child or grandchild and it sounds exactly like them, if you have a code word set up, that kind of just like bypasses that whole thing. So
I like that idea.
Yeah.
Just don't forget your code
Yeah,
word.
yeah. Don't forget your code word.
The backup to the code word too or something.
Yeah. Don't write it down digitally. And yeah.
Yeah, it sounds, I mean, yeah, the idea of like having a family password or whatever
Right.
seems so silly, right? But I mean, it really makes a lot of sense. And it's
Yeah.
especially with all this AI stuff, it really like we're on, I think, day one just of all the different uses that scams are not, other stuff as well, but
Yeah.
Day one of what people are going to be able to do with these tools, right? So
Yeah.
it sounds like something from a movie or something like that, but having those kind of like fail-safe switches, whatever you want to call it, really will be helpful. And you just do it. It takes a couple phone calls to set it with your family to figure it out, and then you're done, kind of thing. You don't have to do it again, right? But it's one of those things, just kind of weird, kind of
that's right. Yeah.
Right.
Yeah. Yeah, it's going to be a weird new kind of phenomenon if people really do start doing that en masse. But I think it's going to be helpful. And also with AI video, things are getting, really impressive in a really quick manner. And I think that's only going to accelerate, things with like Google VO3 is putting out some like seriously good videos. And it's probably not too long before you can just easily say, create a video using a photo of someone, and then it'll just create a video, impersonate the audio. And next thing you know, boom, you've got a replica.
Yeah, future is going to be scary.
Yeah.
That one article I liked from this one too was Dr. Maura Ferguson touched on kind of the psychological, what's it called, the hidden forces behind your money habits. So she touches a bit on like the psychological side of things.
Nice.
How people feel about money, and feeling guilty about wanting to make more money or more savings, things like that. So it's just the psychology side of finance is so important, and
Right.
I don't know that it gets overlooked, but I oftentimes can kind of fall into the back of people's minds of the back burner. So I like the call it the touch on more the psychological side in this issue as well.
Nice. Yeah, that's a good one. Yeah, I think it's an interesting concept. I think a lot of people might feel guilty about trying to make more money or earning a high return or on your investments or whatever it might be. But, when you boil it down, it's really just comes down to, the delaying consumption. So, if you took your money and instantly bought something like a TV, you're getting instant consumption. But if you instead delayed that TV purchase, invested it, you're taking on a risk, and the return you receive is the reward for delaying consumption, essentially. When
hopefully that's
really yeah. I mean, hopefully, yeah. That's right. I mean, long enough time frame. Yeah. Okay. Nice article. Okay, cool. So next we'll get into some of these noteworthy questions. So Ryan has picked kind of 2 questions from our Q&A section on 5i Research that, he really liked, and then I've also picked 2. So Ryan, do you want to start with yours there?
Yeah. So at 5i, we have a Q&A section. People can ask us any question really, and our goal is just to get back something that leaves the question asker with at least more information than what they left with, kind of thing. And there's a whole database of a bunch of years and years and years of questions that people kind of sift through and stuff. So it's a pretty cool little tool for people. So the one question that jumped out at me was, now you've answered tens of thousands of questions. What are some of your least favorite questions that you get? So one of them is just, why is stock XYZ up or down 5%? And these can be frustrating just because any given day in the short term, there can be, for one, no reason a stock is moving up or down a certain amount, or there can be a million small reasons you can attribute to a stock move. And oftentimes these are off of the a stock that maybe a stock's up like 50% over the last year, right? It's like, so it's done nothing but gone up for the last 6 months or year or whatever, and then it has a little dip at 5% dip or something like that. It's like, what's happening here? Because people aren't used to it going down, right? So those, I mean, sometimes you just have to kind of zoom out and kind of put that into context. I mean, volatility is, I think most people don't like volatility, obviously, but especially in kind of smaller types of stocks too. I mean, a 5% move is not regular on a daily basis, but a 5% move is pretty normal over a week, 5 days kind of thing like that. So those ones are can be the one of the ones that we like the least. And oftentimes, if there's news, if there's material news, then that's probably the reason why it's moving. You can look into that. But when there's no news, nothing public, there's no magical answer to why a stock. Sometimes just if the market's down a certain amount, that stock is going to be down something plus or minus that amount too, right? So.
Yeah, no, I like that. And usually I kind of follow like the random walk theory where like stocks move up and down, and just, if you kind of zoom out, you get the greater picture, and you understand like, oh, the stock was moving up and to the right over time. It just took 3 to 6 or 12 months or more. But when you look at it week to week, it's, it looks random. So,
for sure. Yeah. And the other one, oftentimes people always want to get a perfect like entry price or a perfect price target.
Right.
And those ones, like obviously everyone, you want to nail the bottom or whatever on a stock, right? But oftentimes we find it's missing the forest for the trees. So you're looking at a company, you've done your work on it, you're comfortable with it, you like it, you think it's going to do well.
Yeah.
You're probably not going to own it thinking it's only going to go up 10%.
Right.
You're probably owning it thinking, this over X number of years, whatever my holding period is, this stock's going to go up hopefully 50% or something over that holding period, right?
Yeah.
So when people try to kind of quibbles, maybe not a fair word, but we'll use them, quibble over that 2% perfect, like 2% lower price to try to just get that perfect 50 cents lower or whatever. Oftentimes in the scheme of things, especially if it's that next great stock, whether you get it 2% or 5% lower, it's not really gonna make a big difference.
Yeah.
But you're also gonna add more risk to it too, because you're probably going to what usually happens is the stock actually doesn't go down, it doesn't dip to that magical target price you have. Instead, it actually just keeps going up, and then you never buy it.
You're stuck on the
sideline.
Still
going up, and you anchor to this kind of this price that was never gonna trigger anyways, kind of thing. And so that can kind of lead to a lot of missed opportunities, I think.
Yeah, I think that like feeds into like people get kind of greedy to the downside, too. Like especially in like slowish markets, people I find really can get greedy to the downside, where like things keep going lower and they'll just keep lowering their price target. Like, okay, I'll get in when it's 5% lower. Okay, another 5% lower. And like you said, if it's a good long-term stock, you really just like you want to get in and then just kind of hold it. And so that way that avoids you being stuck on the sidelines or anything like that.
And the other thing you do, you can always average in too, right? Nothing says you have to, whatever your full position is, you have to go fully into it, right? Nibble away. If it goes up, great, nibble a bit more. And if it goes down, hey, nibble again and get a better price, kind of thing. So
for sure.
The second one is when to sell winning stocks. So when to sell is always kind of the hardest, one of the harder things in investing. And we find that in our experience, most investors sell way too early. It's, I've made a bit of a gain on this, going to take the profits and run, kind of thing. But usually stocks are going up for a good reason. Something good at the company is happening. Markets are understanding the story better, and that's why it's going up, and the momentum tends to continue. So when every time you sell these winning stocks, you're sort of truncating your potential returns, which over time doesn't work. And then if you sell all your winners, you're going to be left with your losers, which is a great outcome as well. So when to sell winning stocks, there's obviously the answer is in hindsight, whatever the top was, kind of thing. So you never know that perfect price. But the nice thing about if it's a winner, the selling kind of happens naturally if you rebalance, right? So you have a certain target weighting for a holding, stock goes up, and your weighting's now too far above what your target is. So you trim it, bring it back down to that full price, and maybe it goes up again. And then you trim it, and it goes back down to the price. And the next thing you know, it's still a big part of your portfolio, but you've taken a large amount of your gains off of it over time, and then maybe at a certain point it's, or maybe you sort of just trimmed it over a year, and now it's a small part of your portfolio. You're not that interested in it anymore for whatever reason, and then it's too small, you don't want to add to it, so that probably means it's just a sell at this point anyway.
Yeah, no, I like that. It's a really good like rules-based approach to portfolio management and like trimming winners, and that kind of makes it easy for investors. Like you don't have to think about like, oh, I'm up a 2x on this stock, or oh, it's it reported really good earnings and maybe this pop is unsustainable or something. Like you don't have, it takes away a lot of that like guesswork. You can kind of just follow a rules-based approach and say, oh, it's at this percentage of my portfolio. Beyond that is kind of outside of my risk tolerance, and that's when you decide to trim. So it's a good portfolio management strategy. I like that. Yeah.
All right, it's your turn. Questions.
All right, here we go. Okay, so I'm going to pull up a slide. So my first noteworthy questions from the queue is a question from a member who says, given today's unsettled economic atmosphere, which investment sectors would you favor and in what proportion? Many thanks for your stellar service. So we responded, and essentially I'm going to break this down into a few different components, but really in this economic climate today, and this is kind of as of taping, we had the April drawdown. It was like a 20+% correction in the markets. things got really fearful for a while. We had the VIX, spiking above 40. The drawdown was pretty significant. And I think there were some investors that sold or bought international stocks or whatever it might have been, gone to cash. And now we're here. And so the market's about like 1% away from an all-time high. So kind of how I'm viewing this is really, I think I want to break this down into like two different camps of investors. So really we have, camp A is how I'm framing it. So camp A is like the investor that feels like the geopolitical and economic landscape will remain uncertain and the markets might stay flat, decline slightly. And then we have, camp B. So camp B is the investor that says the geopolitical and economic landscape will remain uncertain, but despite this, the markets will grind higher to new highs. And so really where I'm at and where I think a lot of, 5i employees are at is also that, we're in camp B, that, the markets will climb this wall of worry and grind to new highs. It's not the first time that we've seen the market kind of do that, where, we get some sort of huge economic shock, the markets draw down, we do like a waterfall type decline, there's a V recovery, it's really sharp. And even despite all of like the broader surrounding uncertainty in the markets just keep moving higher. And I think it shocks a lot of people. It's like day after day, we can see like a, 0.25% move, 0.5% move in the markets up. And it kind of surprises people. It seems like relentless. So that's certainly the camp that I'm in. And then, picking sectors for an investor that's in camp B is we're really looking at the more cyclical type of sectors. So, I like the tech, consumer cyclical, industrials, financials, with really, kind of a tilt towards tech, financials, and industrials today. And so I think, when we see like an economic recovery, we have markets about to hit new all-time highs. I think that, those cyclical sectors are the ones that are going to outperform. And I think that's where investors, especially those in camp B, really want to be.
So. I'm surprised at how well industrials have done.
Yeah.
Especially a bit of at least a macro view, hearing a lot about kind of a weaker industrials type or weaker economic backdrop in general, and to see industrials kind of powering through it is interesting.
Yeah, definitely. It's interesting, because it would be the most heavily hit by tariffs. But I think, through all of this, I think what we're seeing is the market really sniff out tariffs and look through them and kind of gauge that, we've got this recent trend of tariff rates coming down. Obviously 150% on China was long-term unsustainable. And so they're coming down. And I think what the markets is going to start pricing in, or is already pricing in, is essentially a baseline 10% tariff rate. And I think that's why we're seeing all of these cyclical sectors do really well.
Makes sense.
Yeah, I think that's the camp I'm in. So that's my first question. Next question is a really brief one, but I thought it was pretty important. So the question is, for the long term, what are your top 4 Canadian picks, excluding tech and commodities? So I like this question because it's like, there's not too many Canadian tech names, but even still, I found this list to be like a really strong list of a concise list of strong Canadian names outside of the tech sector. So the names that we have here are BN, which is Brookfield, IFC, which is Intact Financial, WSP, which is WSP Global, industrial name, and then DOL, which is Dollarama. So, mid to large cap names in the Canadian space, mostly across, financials, industrials, consumer staples. And long term, these have just been really nice compounders. Canadians have made, good money in these names. And through thick and thin, they just kind of seem to bounce back. They do really well. And they're just super resilient names. So I kind of like that list of names.
And obviously, do your own due diligence before making any investment decisions. Consult an advisor where appropriate. And either Chris or I are able to trade in individual Canadian securities. So there'd be no, we don't own there'd be no ownership or financial interest in those names. And then earlier, any Canadian names we discussed as well, there'd be no financial interest in those either. So
that's right. Yeah. Okay. So the next section that we're going to be talking about is highlighting a recent 5i report. This is a new company that we initiated new coverage on at 5i. It's D2L. The ticker is DTOL. And essentially what they do is they're a Canadian education tech company. They operate what they call an LMS. It's learning management system. So this is like a cloud-based SaaS kind of platform. They focus on kindergarten to grade 12, higher education, corporate training programs. And actually, this is across the globe, so it's not just in Canada, but it enables online courses, hybrid learning, virtual learning environments, corporate training programs, and more. They have a really good, like, sticky revenue base, 88% recurring revenues. It's a subscription model, so kind of a really good like SaaS type model. High customer retention, and actually most of its sales come from the US, with Canada and the rest of the world making up the remainder. It's working on achieving the Rule of 40. So fiscal year 2025, it had a 26% score, so it's getting there. And then essentially due to its SaaS-based nature, it can really scale up its earnings quickly. It's seen margin expansion. It's now profitable, has a good diversified customer base, positive free cash flows. And recently it had pretty good earnings where guidance was reaffirmed. Sales rose 9%. So its top line is kind of like moderate growth, but it bought back some shares in the quarter, and margin expansion was, kind of a relief for investors. So it actually jumped like 10% on that day, and it's been making some positive momentum recently. So I like this name because it's kind of, it's a SaaS model, it's subscription, it's operating in a niche kind of market. I think it's going to be a growing market over the years, like virtual learning, corporate learning that's in like virtual environments, even for like, the schooling system, things like that. And especially globally, I think that's going to be important as well. So yeah, really like a niche kind of sector, solid company that's growing and expanding. And I've pulled up some of its metrics here. So we kind of have, some revenue, gross profit metrics, EBITDA, cash flow, but largely we can see like the trend for almost all of those is up and to the right. And that middle one where it flipped from the red bars, which were negative, to the positive bars, that's its, profitability. So we can see that recently it's inflected positive for profitability. It's a really good sign. It's cash flow positive. Trades at like 20 times forward earnings. So it's not too bad for a tech company. So yeah, I think it's just kind of like a nice little name that, is showing good fundamentals, and I think its price action can catch up, and it still hasn't fully recovered from that April dip. So I kind of like it here.
You mentioned Rule of 40 on that as well, just for people who don't know. So that's when your revenue growth rate and your gross margin add up to 40 profit margins really add up to or exceed 40%. So and that's just a kind of a rule of thumb that software companies tend to use. It's like a very good spot to be in. So
yeah.
Nice, interesting company though.
Yeah, it's a nice little name.
This is one interesting because, or another, frustrating, interesting, I don't know, whatever you want to call it, but the liquidity on this is quite low, I believe.
Right.
Obviously, risk to keep in mind. But it's a really strange phenomenon with TSX companies. I find you have some interesting, growthy, smaller but growthy type of names, and there's almost no liquidity. And right, we saw this one that we recently went private, Andlauer Healthcare.
That's right. Yeah. Andlauer.
And they, it was like I think it was $1 billion company, right?
Yeah.
And there's just no volume.
Yeah.
There was the owners had.
Yeah, there was a huge stake.
Shares, in fairness, but just some of these kind of interesting names. There's, and it's something you got to watch out for. But there's just next to no liquidity in some of these, which is I don't really know how you solve the problem, but it can be frustrating just because I think that, especially in Canada on TSX, there's a lot of great companies that just don't get the attention they deserve.
Yeah.
That probably also causes other companies potentially looking for an IPO in Canada to maybe think twice
Yeah.
about it. I'm going to go through all this work and we're not even going to be able to, no one's going to even be trading the shares kind of thing. Right. So,
yeah.
Yeah.
No, it's an interesting dilemma. It's good and bad in that, the good is that it enables investors, I think, to like get in and find good value, and you can look at something that's like cheap on a valuation but still growing. But also, like you said, sometimes they just don't move even on positive market days. So Next topic we want to talk about is a bit of investor education. So this is like kind of a super broad and open-ended kind of investor education segment. And so what I wanted to talk about in this was, on the topic of how to make and keep money in the stock market. I think it's going to be incredibly pertinent to the market that we're coming into, the market that we're kind of in right now. So essentially, in bull markets, especially frothy bull markets, near the end of like a bull cycle, it can be pretty easy for most investors to make money in the markets, like whether it's meme stocks, wheat stocks, crypto stocks. There's just like periods of time in the markets where seemingly everything's going up day after day. So we saw this in between 2020 to 2021. We have seen in other periods as well, like 2017 was a really good year for that, 2013 as well. And these are times where like, mega cap stocks are going up, the small speculative sort of stocks are going up, and investors can kind of easily jump into these, and profits are kind of abound. And so this is the stage of the cycle where everyone starts comparing themselves to their neighbors. So they're looking at their neighbor that made a killing on like the next big thing. And, the problem is this is where a lot of money can be made, but also where a lot of people lose unrealized gains, or we kind of enter into some sort of like frothy market. So,
one thing so I get what you're saying on easy to make money, but I disagree with do you have they're not seeing the slide here yet. Okay. So, but you have the line here, if it can be easy to make money in a bull market. And I disagree with that in the sense that it can, in hindsight, it looks easy to make money in a bull market, but so many times I've seen where markets are just grinding higher, and you have a lot of people on the sidelines, or there's always some reason not to buy or not to own the bull market. Valuations are too high, it's too frothy, whatever, they're going to cut rates or raise rates or inflation or whatever. There's always a reason not to own. So it's not easy. I think bull markets are actually, they're in hindsight, it looks very easy to make money, but I think along that journey, when you're in it, there's so many investors out there, so many reasons being thrown at you not to own. Buying and holding and staying invested, I think is going to be one of the hardest things to do. And not many people do it, I think. So I get what you're saying there. That's my one. I'm going to nitpick that.
That's fair. So on a week-to-week basis, day-to-day, it's certainly like there's a lot of reasons not to own stocks or fears. But in these sort of, frothy bull markets where, the market's making new highs and it's kind of making new highs every day, owning a basket of broad stocks as well as like even the smaller, riskier ones tend to go up with the markets, and the markets kind of have this like massive breadth expansion. So I've analyzed it, in these sort of like bull markets where it's, peak bull market, something like 90 to 95% of stocks are higher year over year. So investors that kind of hold stocks and make money, it can be easy in hindsight to see gains, particularly unrealized gains. But, I want to kind of highlight it back to the GameStop meme stock craze. So, watching the documentary, there were so many individuals that were interviewed who saw their portfolios rise like multiple fold. But the key takeaway that I got from that was that, at the end, kind of spoiler alert, only a handful were actually able to sell, keep the money, and benefit. So when we see these like types of high risk, high reward opportunities, this is generally how it plays out. Not everyone can sell at the top, or else there would be no top. And so it's a really risky game to play in that sense. And so like a few key takeaways from all of this. First is that I think from what I'm kind of gauging and what I'm looking at, it does seem like we're entering into maybe the early parts of some sort of stage like this. We're seeing a lot of IPOs kind of move higher. We're seeing a lot of pre-revenue sort of emerging technology stocks move higher. And so this is kind of reminiscent of those early stages of a frothy market for me. So a few key takeaways. One is, to not rush into the next big thing with a big position size. So whether it's like space stocks, nuclear stocks, AI data center plays, quantum, entering into these at a frothy price point and with a heavily weighted position right off the bat can be like a good way to lose money. And then if an investor does buy some of these and make a good return on these types of stocks in a frothy market, what I want to emphasize is like starting the practice of taking out gains. So even just the muscle memory of taking out like small gains really helps to just build in that, process of like selling, taking profits all along the way. Because, investors don't want to become the next like GameStop person that saw their portfolio go up multiple fold and they just never sold. So even taking little profits really helps along the way.
Essentially, there you're just talking the rebalancing, right? Like that's when how many stock grows in your portfolio. It gets a bit too big, you rebalance, take some profits, maybe put it somewhere else. Don't let your portfolio become a bet on that one name or one sector that's doing really well, right?
Yeah, exactly. Whether it's, if you want to do the rebalancing approach or other approach, whether it's just dollar amount that someone's uncomfortable with, that works as well. And then lastly, while I'm talking a lot about like frothy stocks and like speculative stocks, I think at 5i, we really prefer buying like high quality stocks that have outsized market return potential, where timing is less important. So, and these types of stocks don't really exhibit cyclical behavior. So, for example, Constellation Software, the ticker is CSU. Over the years, many investors have made big money on this stock, but it didn't happen overnight. So, CSU has grown at an annualized rate of about like 37% over the past 19 years, so almost 20 years. And at that rate, that means essentially CSU doubles like every 2 years on average. That's kind of how the math plays out. So a 2x every 2 years worked out to about a 10x in 6 years or so at that 37% kind of rate. And this is all while the stock really didn't have meaningful drawdowns like a lot of these other, meme stocks or kind of speculative names do. So I kind of want to highlight both like the divergence between or the juxtaposition between like the frothy speculative names and how they have outsized returns, but also like the long-term investment of high quality names that can compound nicely over years and how they can have very similar returns, but with a lot less volatility and a lot less need to try and time things.
Yeah, you don't need to own speculative, questionable type of investments or companies to make money in the market, right? Like you can own good quality operating companies that over time do quite well. And it's kind of like the power of compounding, right? It's just if you hold it for 5-10 years kind of thing, it works out. They can work out very, very well and they can be life-changing, honestly. So, it's a good, I think and because the media is always in your face with everything, any stuff that's had a big one-day move or whatever, I think people really do get focused on kind of the speculative meme type of stuff, and it's kind of like the siren song or whatever, and you don't need to invest in that stuff to do fine in the markets kind of thing, right? And obviously you're talking about how Constellation's done so well over the years. Obviously past performance is not the results, but that one has been just an amazing company to own for people. So.
Yep, for sure. Yeah, and a bit of hindsight bias on that one as well. And so, it's easy to kind of look back and think about Constellation, but
fine. So it can be easy to make money in a bull market kind of thing. Is Constellation Software is a great example, and again, no position in this company, but that's a great example because you look at the chart, it's like, oh, it's just so obvious, like so easy to own. It's all it's done is gone up or whatever. Right? But I remember, I think we were first talking about that one when it was in like the double digits. Like so like $90 or something like that. And even at that time, the common issue was people didn't want to own it because the valuation was too high. You can't justify owning it at these levels, kind of thing. And over 10 years, it's just gone up. Not every company that has a high valuation is going to do that, obviously, but and Constellation truly is like a one of a kind type of company, I think. But just a classic example of it looks easy to own that over the last decade or whatever it has been, but in the moment it's never as simple or easy as it looks. So
yeah, definitely.
All right, I think we're almost an hour here, so I think we can probably close off here. If you like this, give it a, I don't know what even platforms give me. I'm gonna give it a like, star, or upvote, or thumbs up, or whatever it is. So and put in some comments on whatever platform you're watching or listening on too. So.
Yeah, no, definitely. Yeah. So thanks a lot for joining, everyone. So we'll be doing some of these podcasts on a regular basis, as well as the one with Michael and myself, and investors can kind of just flip between the two, and we'll be talking about, US stocks, Canadian stocks, the markets, whatever it might be. And so thanks a lot for joining, and see you next time.
3, 2, 1.